Are you looking to buy a home? The best loans go to the best borrowers, and the best borrowers have high credit scores. On today's episode, we're going to go over how to maximize your credit score. Hello, and welcome back to the Happy House Hacking Podcast, the podcast designed to help young people in California navigate the path to happy home ownership. I am your host, Owen Schwagerly. I am a realtor, investor, and happy house hacker. And today, we are going to be talking about credit scores, what they are, what they mean, and how important they are for your real estate journey. Okay, so let's start from the beginning. What is a credit score? Now, when a bank is going to give somebody some money, they want to know how likely is this person to repay it. And it's really hard to sum up a person's character. And so what they've done is they've come up with a way to do that. They've just put a number to it where it essentially reflects what your likelihood to repay is. And there's rankings with, low as in the 300s up to 800. And you're somewhere in the range there based upon what these credit institutions look at. And so it's always been a mystery. Like, how do I know what my credit score is, or how do I improve my credit score? So on today's episode, we're going to go through what your credit score is, how they determine it, what variables go into determining it, and what you can do to control it and improve it. Okay, so we've heard the term FICO score, you've heard the term Experian, TransUnion. What do all these terms mean? Essentially, there's a couple different credit agencies out there that will consolidate those numbers and come up with what that score is. And so there's some great tools out there. You can sign up for something for free called Credit Karma, and it's a great app that will help you track your credit score. And so, uh, knowing what your credit score is and what affects it is going to help you on your real estate journey. For example, a 50-point difference on your credit score could result in thousands and thousands of dollars saved in interest on a loan when you go to buy a house. So, this is really important and this really matters. Now, some people don't have credit. Some people haven't ever started their credit journey. And there is reasons for that. There are risks involved in having access to credit. They give out these credit cards like candy sometimes. Like when you first go off to college, you're outside of your parents' home, you're on a college campus, and they're out there boothing saying, "Hey, do you want a credit card? Let's get you signed up." And then they dish out these credit cards to college students who may not yet know how to manage their finances well. And so it is a tool. And so it has some very great power benefit to it. And it can also be dangerous if used incorrectly. So we're going to go through what surmises a credit score. What is a credit score made up of? And then we'll talk about what you can do to change your credit score. Okay, so they break it down into 5 major categories. So each one of these categories affects how they look at the full picture of you as a borrower, whether or not you're credit worthy. Okay, so first is your payment history. This is really important. They want to know, are you making your payments on time or are you late? Payment history is essentially 35% of what they look at when they're analyzing you in the whole picture. So if you're late, that's going to have a big impact on what your ultimate credit score is going to turn out to be. So if you do set up a credit, either a credit card or you're on a student loan or you've got a car loan, make sure you always pay on time. Don't be late, because if you are late, that's a ding on your credit history. The best borrowers who get access to the best financing have a clean track record where they are making their payments. And so, uh, with the credit card, it usually, you use it 1 month and then you have the statement, and then it's next month you're supposed to pay once that statement comes. So you have 30 days after you spend to really pay it back. You really want to make sure you pay that in full every single time before it's due. You don't want to make the minimum payment. And this is where the danger lies. People max out those credit cards and then they have high balances with high interest debt. And then they get in a really bad situation with a lot of credit that's hard to pay off. So, number one, make sure you're always paying on time. That's payment history. 35% of your credit score is based on that. Number two, credit utilization. This actually is about 30% of your credit score. Like, this is huge. And a lot of people don't know this, but what they're looking for is they want to see how much of your access to credit are you utilizing. So, for example, let's say you had a credit card and the line of credit was for $1,000. They want to see you not use more than 30% of that line of credit. So, if you have a credit card with only $1,000 limit, don't spend more than $300 at a time on that credit card, or else they're going to see you as a higher risk borrower. And so, we've seen people with this one tip, this one strategy right here has helped them bump their credit scores 30 to 50 points. Stay underneath a 30% credit utilization limit. And so the way that works, let's say your credit card statement, you have to make the payment by the first. Make sure that before the first, that credit utilization limit is below that 30% threshold. And so that means you could potentially, spend $500 that one month, but make sure you pay it down to be below 30% utilization by the time the next statement in the bill is due. So that's a really key tip. You want to keep that credit utilization limit. And another way you can actually bump your credit score is by increasing the access to credit that you have. So it's pretty easy. You can actually call your bank or call your credit card company and say, hey, look, I've got a $1,000 line of credit. I really have been, making my payments and I'm, making sure to not go crazy here, spending too much money. Would you please increase that line of credit for me? And then you could ask them to increase that maybe to $8,000 or $10,000. And here's why you would want to do that. The people who have the best credit scores are people who have a very low credit utilization limit. And I'm talking like a 6 to 8% credit utilization limit. So, in that scenario, if you got a credit card with the ability to have up to $10,000 made available to you, but you're only using 6 to 8% of it, that means that you're only using $600 to $800 on that card per month, and you're always paying it off on time. And that's how you get your credit score to really skyrocket up to those new heights. So make sure you have your credit utilization under 30%, but it would be even better if you're using only 10% or less of the access to credit that you have. And so, number one, payment history, always pay on time. Number two, credit utilization. Make sure that you have access to a balance that's enough to cover what you would need. And don't ever go close to the full 100% utilization. You always want to stay below 30. And then number three, length of credit history. 15% of your credit score is based on the length of the history that you have for your credit cards and lines of credit or car loans, personal loans, all of that. So what that means is if you're trying to go and buy a house like right now and you don't have any credit at all, you've never opened up a credit card, you don't have any loans or debts, good for you. That's great. You don't have any payments. That's a really good place to be in. However, it's going to take you time to build up your credit score because 15% of your credit score is based on the length of your credit. And so, a great tip is simply open up a single credit card that you could use that will have you know access to a decent amount of capital in case you wanted to buy something, but always pay it off and just have that one credit card, starting in possibly college, maybe even high school. The younger you are, where you can start your credit journey, the better your score is ultimately going to become, because now the credit companies can look at you and say, wow, this guy's got 10 years of history on his credit card and he's never missed a payment. He's going to be a good borrower. If he borrows money from us to buy a house, we can trust this guy. He's going to do good. So 15% length of credit history. Now, number 4 is credit mix. They actually give you 10% of your score determined by how many different types of loans you have. And I remember when I was starting out, I thought this one was kind of crazy because I didn't have any student loan debt, very fortunate and blessed, didn't have any car loans, always purchased cars for cash, kind of the Dave Ramsey way. And so I didn't have a high mix of different loan products. And so you do have 10% of your credit score tied to the mix of different loans that you have. And so this one, since it is smaller, it's only 10%. I'd say don't go out there and open up all kinds of different types of loans just because you're trying to increase your credit score. For example, don't go out there and buy a new car just so you have a car loan and a credit card now. If you don't need to go that route and get the car loan, don't get the car loan. You'll be in a much better position because that debt to income ratio will be affected. And let's say the car loan is $500 per month. That is $500 per month taken away from what you could put towards a mortgage. So if you could still buy a car for cash or have the car paid off, go that route. Don't simply focus on trying to get multiple different types of debt because you think it will help your credit score. Okay, then there's number 5, new credit inquiries. And this is also a small percentage. 10% of your score is based on new credit inquiries. So, one of the concerns for a lot of buyers starting out in the home buying journey is, ooh, I don't want to talk to a lender yet because I don't want them to pull my credit because I don't want my credit to get hit. I get that. I've been there and I know that it can be daunting. However, a 10% is a very small percentage of the whole picture. So when they're looking at your credit, they want to see those bigger things first. Number 1, you're making your payments on time. 2, you're not maxing out your credit lines. You're keeping them underneath 30%, and that you've got a lengthy history of repayment. Those are the bigger chunks of the pie. And so another thing too about those lenders is they don't have to do a hard pull on your credit score if you don't want to. You can ask them to do a soft pull. You can even preliminarily do a soft pull yourself through Credit Karma and have that information to share with a lender to get the process started to get you your pre-approval. And ultimately, you do want to do that hard pull because the lender isn't going to have a firm idea on where you're at with your finances until you do that hard pull. That hard pull gives them access to way more information and looks at the whole picture, and then they can plan with you about how to consolidate things or pay things off before you buy and really have that full picture. So those are the 5 factors that go into your credit score. And the biggest tip is work on that credit utilization. Get it below that 30% threshold or increase the line of credit to be a little bit higher than where you're at. Because what we've seen is sometimes people have a credit card with only $1,000 or maybe $2,000, and they're spending and using that. Maybe they spend $1,000 per month through groceries, cars, expenses, and other things. They pay it off every month, but they're utilizing more of it. And so they're putting themselves in a position where their credit score could be negatively impacted. So this is extremely important. And one time I heard a story about a guy who was under contract to buy a house. He had a credit card he'd opened up at Home Depot, and he did it just for the promo. He totally forgot about this card. There was a $25 balance on that credit card, and he forgot about it because it was so small. He just never paid it, and then he went to go buy a house, and then the lender saw this on his credit score and was like, "Oh my goodness, you have this unpaid $25 bill. I'm sorry, we can't give you the loan for the house." And the buyer almost lost the house because of a $25 bill. They had more than enough in their bank account to pay that over many times over. So what this means is you want to be in tune with your credit score. And that's why getting access to Credit Karma so you can keep your eyes on it is going to be really helpful for you. We like to say, what gets measured gets managed. And that's why you want to have access to your credit score so you can manage it and you can see it gives you a little monthly update. Is it going up? Is it going down? And then you can say, oh, okay, when I did this, these habits of, going out, spending food on all the time, it either helped or hindered me on my financial journey. And so those are the types of things that you want to start to track on your credit journey. So, that would be tip number one from a perspective of how to increase your credit score. You got to track it, you got to measure it. And then tip number two, sometimes credit companies have errors, and you can actually dispute those errors and get those things resolved. So there could be an issue where there was like a wrong late payment that could drag your score down. Like maybe you did pay it on time, but it's clocking that you didn't pay it on time. So you can contest that type of information. And I've heard other stories where erroneous charges or credit accounts were opened up in somebody's name. That's more getting into kind of identity theft and identity fraud, which is why it's so important you protect your social security number and your personal information. So just be sure always to do everything you can to protect your identity online. Okay, tip number three, pay down high balances. So if you've got like one credit card with total line of $3,000 and it's the balance is currently at 2,000, and you've got another card that is there, you want to get both cards paid off ultimately. You could do the debt snowball method where you pay down the smallest debt first. Like if you have a $500 balance on another account, boom, 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 pay that down and then focus on the bigger one. But if you're right there on the threshold of being underneath that 30% utilization limit, you may want to consider just paying that down to get it below that 30% and then focus on that debt snowball of getting the small debts paid off so you can really start to see the snowball take off and pay down all of those debts. Number four, you may consider setting up automatic payments. And in the case of that $25 credit card where the guy didn't know, if he had that auto pay set up, it would have just pulled out of his debit card or his bank account and it would have paid it automatically. So there is that as a way to make sure you don't overspend or you miss a payment. However, if you're running tight on your cash flow and you want to manage it, just make sure you put this on your calendar every single month that you are going to log in before your credit date. Maybe it's the first of the month, maybe it's the 15th of the month. There are certain banks like US Bank, it's the last uh, business day of the month that they'll send it out. So if it's a weekend, it may come on a Monday. So there's different rules depending on your bank and local credit unions as well. So make sure you know the rules. My dad always said, learn the rules, play the game. And the credit card score, it's really a game. It's gamifying your personal financial fitness and determining how well you're doing and how lendable you are. Okay. And then step number five, this is another tip. You could become an authorized user, which means you're piggybacking on someone else's good credit with their permission, of course. So what that would do is if you're married or if you're buying it with family members or something, you could be added on to their account. We've done this for clients who were engaged, not quite yet married, but they were going to be. They added on one of the significant others was added on to the other person's score because they hadn't opened up a credit card yet. They'd just been cash, always paying things with a debit card. And so by adding them on, it helped that situation where they were able to get the credit score they needed for the purchasing power. And then tip number six, request a credit limit increase. And it's super simple. The back of your credit card usually has like a phone number on it. You could just call and say, hey, I'd like to increase my credit score, please. Would you please do that? And I mean, that is such a great little tip because it will ultimately increase your access to credit. And as long as you're not using it, that's a good thing. You want to make sure your credit utilization limit is lower than that 30%. Try to get it below 10% if you can. And so, with that in mind, if you know, okay, my total expenses per month, I spend about $1,000 or $2,000 a month on a credit card or debit card, and you have that cash flow coming in from your job or other income where you know you're paying that every single month anyway, you can use the credit card for that purpose. Make sure to pay it down every single month on time, and then you'll start to really build that credit score up even faster. Okay, so credit scores, they are super important, and it would be great if you didn't have to have one. However, if you want to do life in this modern world, in this modern era, having access to credit is extremely important and it can save you money. So instead of running away from it and not wanting to learn about it, or just kind of riding it saying, I don't know what's going to happen, take the time to educate yourself on these tips and make sure that your credit is something that's squeaky clean, because the best borrowers are the people who get the cheapest rates and the best terms when it comes to financing. And we've seen it where, like, yeah, 30, 40 points on your interest rate could turn into a quarter percent, which is like, could be couple $100 per month. So getting your credit score up is super important. And if you haven't opened up any lines of credit yet, you would really want to start considering that as you're getting ready to go on this journey. If you're already on the journey or you already own a home, just making sure you're making those payments and paying down those high balances to get them below the credit utilization limit, and ultimately having them open for a long time in good standing is ultimately what will help you so much on your credit journey. Now, if you like this video, if you like the content we're putting out, please subscribe, like, and follow our podcast on whatever channels that you're watching. If it's YouTube, thank you. Like, subscribe. If you're on Instagram, Facebook, follow us. And please share this with a friend. If you know somebody who could benefit from the information in this podcast, spread the word. Thank you so much, everyone, for tuning in, and we'll see you next time.